If you've heard about Bitcoin before, you've probably heard the advice to buy Bitcoin, but what does this actually mean? In this video, I'll show you how to find a Bitcoin allocation, whether you're just starting out or you've been buying for years. So let's start with the most important question first. How well do you feel like you understand Bitcoin? Because if you're like most people, you find out about it when the price is rising. Bitcoin's price is the best marketing tool that it has. So when it hits all-time highs, every major news outlet will start covering it, and that one Bitcoin friend that you have will start telling you to buy it. So when new investors hear about it, greed is their primary motivation. In a bull market, everyone who's buying feels smart, and this is when people tend to over-allocate and use debt and leverage to start buying even more. And then when the price starts to fall, you get fear. So you get things like panic selling, anger, regret, and distrust in the person that told you to buy it originally. And this psychology applies to every asset, but Bitcoin just amplifies it. And volatility exposes how people really behave with money. Think about this like learning how to sail. You can't control the weather, only the sails and the boat that you're taking. Most investors capsize the first time the storm hits because they never really learned how to steer through volatility in the first place. The solution to this is to scale your allocation with your understanding, education level, and conviction in where Bitcoin's headed long term. Being early means that there's more opportunity ahead of us, but it also means that most people still think Bitcoin's a gamble. And most financial professionals don't see it as a core part of a plan yet. So you really have to understand why you own it, otherwise you'll be tempted to sell at the wrong time. And Bitcoin is the most volatile asset that you can hold, so the better that you understand it, the more you'll be able to sleep at night through all the volatility. Conviction isn't a gut feeling or a blind faith that you have, it's the result of hours of research and analysis that give you the confidence to know that Bitcoin's an undervalued asset and that it's worth holding long term. So let's talk about where to start based off of what level you sit at today. Each level represents a deeper understanding of Bitcoin and a higher level of comfort with the volatility. The first level is foundation. This is where everyone starts. You're new to Bitcoin, you're curious, maybe a little bit skeptical, and you probably see it as a small hedge or an experiment within your portfolio. The best place to start here is an allocation from 1 to 5%, and the best way to get exposure is through an exchange like River or an ETF like FBTC or IBIT. With a small allocation, you'll naturally over time become more interested in it because you financially benefit from it. You'll start doing things like checking the price, and you'll just be more willing to learn about it in general. To move past this stage, you should be able to understand why Bitcoin exists, what problem it solves, and why it's valuable long term. The next stage is integration. You understand the basics now, and Bitcoin no longer feels like a gamble in your portfolio, but more a part of your plan. You see it as a replacement for your growth stocks or your tech exposure and a long-term diversified position in your portfolio. Allocations here can range from 10 to 20%. At this point, it's probably a good idea to at least start learning about self-custody and doing something like sending a small Bitcoin transaction on your own. When I did this myself, it really clicked for me that Bitcoin is outside of the traditional banking system, and it helps you build conviction in the asset in a way that's hands-on and lets you learn about how Bitcoin actually works. Graduation means that you've learned self-custody, you've sent a Bitcoin transaction, and you can clearly understand the difference between Bitcoin and all the other cryptocurrencies. The third path is optimization. At this point, you fully understand and believe in the Bitcoin thesis, and you've lived through enough volatility to get comfortable with it. At this point, Bitcoin becomes the main growth driver of your whole financial plan. Allocations here often range from 25% to 50%, and this means that you're confident in your custody setup, and you may start moving coins off exchanges or out of ETFs to strengthen your security and diversify your storage. Graduation here means that you've mastered self-custody and you understand what running a node is. You can also clearly explain what problems in our current financial system Bitcoin solves. The last path is the sovereign path. This means that you see Bitcoin not just as an investment, but future money and a reserve asset for the world. At this point for you, holding anything other than Bitcoin feels like more of a risk. Allocations here are often 50% or higher. You've optimized your self-custody, whether that's self-custody, multi-sig, or ETFs, or a combination of all three. But just because you can move up a level doesn't necessarily mean that you should. You might be all in on the fact that Bitcoin is the future of money, but that doesn't automatically mean 100% allocation makes sense for your life. So let's talk about the next piece of the puzzle, which is your goals and your time horizon. Every allocation decision should serve a specific purpose, so take a second and ask yourself, what am I trying to achieve? Is it early retirement, financial freedom, or legacy? Maybe you're getting close to retirement and want growth, or you're already retired and looking for an inflation hedge. The answer to this question determines your time horizon, and your time horizon determines how much volatility you can handle. The longer the time horizon, the less short-term price movements actually matter. Historically, Bitcoin has rewarded patience. There's never been a negative 4-year rolling return, and even those who bought in the top in 2017 were only down about 15% 5 years later before the next cycle sent prices even higher. Statistics show that investor behavior can account for more than 50% of missed returns, meaning that even if you own the right asset, selling at the wrong time can ruin your overall performance. The average investor underperforms the market by 1 to 2% per year to timing and behavioral mistakes. This is why getting clear on your goals and your time horizon is so important, because once you understand your short, medium, and long-term goals, you can build a Bitcoin allocation that lets your Bitcoin grow without having to worry about having to sell during a downturn. And most people fall into 3 different stages, so accumulation, pre-retirement, and retirement age. Accumulation means that you're building wealth, you're earning income, and you're investing aggressively. Pre-retirement means that you're focused on protecting what you've built while still growing and preparing to live off of your assets. Retirement age means that you're drawing down and funding lifestyle from what you've already saved. Each stage changes how much volatility you can handle, and it determines how long your time horizon really is. Once you're clear on these, you can map out buckets that give you short-term stability and let your Bitcoin holdings grow long-term. So let me show you how to set that up. The first bucket is your short-term bucket. This is anywhere from 0 to 3 years, and it's going to hold your emergency fund, your runway for bills, and other short-term goals. You can think of this bucket like a shield that helps protect your Bitcoin and your other long-term holdings. Depending on your own stability, life stage, and risk tolerance, this bucket can cover anywhere from 3 months to a couple years. The next bucket is your bridge bucket. This is anywhere from 4 to 10-year goals, and it can be used for things like buying a house, funding college, or starting something like a business. This is where Bitcoin can start to mix in with other things like index funds and dividend stocks, depending on where your conviction level is. And then you'll later sell them into your short-term bucket to fund the goals as they get closer. If you're like me and the idea of having to sell any Bitcoin at all is difficult for you, this bucket lets me allocate some funds to short-term goals to upgrade our family's lifestyle, and it helps balance that with the long-term holdings. The legacy bucket is for 10 years or more, and this is where compounding really starts to take over. Things like your retirement accounts and the majority of your Bitcoin holdings will sit here. The main rule here is that your Bitcoin holdings go in your intermediate term and your long-term buckets, so that the short-term cash allows you to hold through any volatility and avoid selling the bottom. And as you move through life stages, the way that you fill and drain these buckets changes. So for example, during accumulation and pre-retirement, you're filling the buckets from left to right and stacking for long-term compounding. In retirement, you go the other way. So you're refilling the short-term bucket from your bridge and legacy buckets. And when you're retired, you'll want a bit more cash set aside, enough to cover at least 16 months of a bear market to match Bitcoin's longest recovery period. And as your education level and conviction in Bitcoin and where it's going long-term grows, Bitcoin will naturally start to fill out your intermediate and long-term buckets more and more over time. In the foundation stage, your small allocation is a long-term legacy bet. At integration, most still stays in legacy, but a small portion may move into the bridge bucket for midterm goals that are longer than 4 years. Optimization then balances both as Bitcoin becomes your main growth driver. And the sovereign stage, Bitcoin fills all of the legacy with some of the bridge for goals greater than 4 years, but it still doesn't replace your short-term cash runway. For me, this system creates balance, so the short-term cash protects me from having to sell Bitcoin at the wrong time. The bridge bucket funds goals and upgrades in lifestyle for my family, and then the legacy long-term bucket makes sure that I can compound and have Bitcoin set aside that I never plan on selling. The strength of this system is in behavioral management. It reduces stress, keeps you from panic selling, and lets your assets compound through every market cycle. But you still need to make sure that you can actually handle the volatility with the allocation that you've chosen, so let's stress test it. By now, you probably have a good idea of your conviction level, your understanding, and where Bitcoin fits in your plan. But the real question is, could you hold through a worst case scenario? This is like skydiving. You don't check your parachute after you jump. You prepare, inspect, and make sure it's packed right before you ever step off the plane. Because once you're falling, it's too late to fix anything. And a sound financial plan is the same way. It needs to hold even when the market drops fast. And historically, it's not uncommon for Bitcoin to drop anywhere from 70 to 80% in a relatively short period of time. So take a second, take a step back, look at your allocation and pretend that that's happening right now. If it's at a level that you're not comfortable with, you need to adjust it to make sure that you can sleep at night. Here's an example of what your portfolio drawdown would look like with different allocations, assuming all other assets are flat. This is why conviction and understanding of Bitcoin is so important. A 56% drawdown on your net worth in months can be really painful. Having a long-term mindset and ability to hold through has historically gotten you hundreds of percent returns from lows just a few years later. And selling at the bottom would be devastating for your long-term growth. If you feel like you could survive this, then you're probably closing in and getting closer to the correct allocation. And if all three of your buckets are allocated to your goals, your risk tolerance, and your time horizon, then you shouldn't have anything to worry about in a worst case scenario. So let's run through an example scenario of how to structure this. I had a viewer email me about a week ago asking about his allocation and questions about what to do next. So let me walk you through his situation as a real example of how you can put all of this into practice. So John's 37, he's married with 3 kids and the only income provider. He earns about $285,000 a year and they plan on saving about $60,000 after expenses. Like a lot of families, most of his wealth is tied up in real estate. His total net worth is about $795,000. Around 81% of it is home equity, 5% in cash, 10% in Bitcoin, and the rest in their cars. After learning more about Bitcoin, they're selling their house to downsize, free up home equity, and live in a smaller rental that they already owned previously. John's problem now is that he's unsure of how to allocate the home equity lump sum he's about to get from the sale and wants guidance on how to meet all of his goals. So let's walk through how I would structure this kind of plan based off the 4 steps that we've covered in the video. He understands Bitcoin well, he has self-custody, he runs a node, and he's pretty comfortable with having the majority of his net worth in Bitcoin, but he's also comfortable with having some diversification in real estate because that's what he knows and that's what he's been comfortable with in the past. He started buying in early 2024, so he's experienced some volatility, but he hasn't experienced a drawdown over 50%, so we'll put him right on the edge of the sovereign path. Their primary goals are that they want to move in 2 to 3 years to a larger house to have space for all of their kids. They want to fund all 3 of their kids' college, have 2 to 3 vacations a year, and his main goal is to retire at 45 years old to have more time to spend with his family and pursue more meaningful work to him. When he retires at 45, his goal is to have $200,000 as a salary, which with the equivalent with inflation would be around $253,000 in 8 years when he turns 45. As the sole income provider with 3 kids, we'll start by bumping the emergency fund up to around 6 months, and then adding an additional fund for vacations to fund their 2 to 3 vacations every year in the short-term bucket. And then the smaller house they're about to move into has about $250,000 in home equity, so we'll leave that there for now, giving them diversification and some options down the road if he chooses to do something else with it. Because any Bitcoin investment that's less than 4 years should be seen as speculative because short-term price movements are extremely difficult to predict. Then he can revisit this in 2 years when they go to buy the larger house, and he has a few options. So he can cash out, refinance, and keep the house as a rental and use that cash as the down payment for the larger house. He can sell the house and use all of the home equity as the down payment on the new house, or he can sell the house and use a portion of that equity as a down payment and put the rest into Bitcoin. Their oldest is about 10 years away from starting college, and if we use the averages and adjust for inflation, you're looking at around $160,000 per year that you need to fund for tuition. If we put $30,000 in the bridge bucket to save for this and then compound at 30% into Bitcoin over the same time period, you'll have around $410,000, which should cover all 3 of his kids if you're taking those funds out as they go through school. The remaining $320,000 goes into the legacy bucket into Bitcoin to fund his early retirement goal. And John's also planning on putting $4,000 a month as a dollar cost average into Bitcoin from his income for the next 8 years. If we take the same 30% annual growth rate on Bitcoin over the next 8 years, he's looking at around $4.6 million at age 45 when he plans on retiring. Using an 8% withdrawal rule that fits a higher growth asset like Bitcoin compared to the traditional 4% withdrawal rule, John can withdraw $365,000 at age 45 per year without depleting the nest egg over time. Next is the stress test. If Bitcoin drops 70%, could this family endure this? The answer is yes, because their short-term and their bridge buckets give them multiple years of runway without having to sell any of their long-term Bitcoin. His income stability paired with the 6-month emergency fund make the volatility survivable. Instead of being over-allocated into real estate, John now has a simple, flexible structure that aligns with his beliefs, allows him to fund his goals, and not sacrifice major milestones with his family along the way. This is just an educational example. It's not meant to be financial advice, but it shows you how a simple framework can help you think clearly about where Bitcoin fits in your financial plan. This is just one example of many different scenarios that I could go through, and your allocation is going to change based off of all of these factors combined. So let me break down how you can apply all of this information yourself. All right, so let's just recap the 4 steps. Number 1, choose your Bitcoin path based off your education and conviction level. Number 2, define your goal and your time horizon. Number 3, structure liquidity with the 3 bucket strategy. Number 4, stress test it until you can sleep at night. This is your foundation that you can start from, and then you can revisit this video or these steps as your goals change, your conviction level and understanding in Bitcoin changes, or you enter a new stage of life. So yes, buy Bitcoin, but do it in a way that matches your time horizon, your conviction level, and your life. My name's Austin. Thank you so much for watching, and I'll see you in the next video.